Hi, I'm Merryn Somerset Webb, Editor-in-Chief of MoneyWeek magazine. Welcome to another one of our video interviews. We're on a roll at the moment. We've had some brilliant people on recently, and we have another one today. With me is Gervais Williams, who is manager of a variety of different funds, but two we're going to talk about in particular today are the Diverse Income Trust and the Miton UK Microcap Trust. So two interesting funds and an awful lot to talk about if we're going to talk about microcaps, small companies, the market in general, income, dividends, etc. Where should we start? Let's start with microcaps. We were talking earlier about a lot of inefficiencies in the market. You said the small cap sector at the moment is displaying inefficiencies. What do you mean by that? What's the problem in the market?
As you know, the market's been pretty unsettled at the start of the year. It's been dominated by severe movements, very volatile movements. Further dividend cuts, we probably had 4 or 5 in the FTSE 100 already this year already. And that's led to a lot of people pulling back, being a little bit more cautious about what they're doing. And that's led to share prices probably being illiquid and moving more substantially than usual. And that's happened in the FTSE companies. They've moved back up to almost the same level as they were at the start of the year. But at the smaller end, they're small, they're kind of easy to ignore, and there are some share prices which just have been moving too far and have not recovered as much as they should. And so you've got extreme inefficiency at the bottom end of the market.
Are you telling us that your microcap trust has performed really badly recently?
Certainly not, actually. It's actually been amazing. I mean, we set it up only, 9-12 months ago. It was set up in April of last year, just ahead of the election. Clearly, the markets were quite a high at that stage. Nearly all markets around the world have come off a bit since then. And this is a fund which has not just generated an attractive return, but even in spite of the costs of investing, it's made absolute gains in a period when most funds have gone down. Okay,
brilliant. Now, for readers who aren't experienced in this area of the market, can you define a microcap for me? What's the difference between a microcap, a small cap, and a large cap?
Yeah, the truth is that these are slightly fluid. There's not very many. So what tends to happen is most people call small caps stocks which are a billion or perhaps a couple of billion size.
In market capitalisation, to be clear.
In market capitalisation, pounds, yes. But so there's quite a lot of big companies in the US and small companies, which are defined as small companies in the US. There's quite a lot in the same area where you call mid-sized companies, which are some people call small companies. What we're really interested in is companies which in themselves are less dependent on the world economy. They've got the ability to grow irrespective of the slowdown in the world economy. And particularly in the microcaps, they're probably more local businesses. They might still have a big world market position, but they're quite small local businesses which are able through their niche to continue expanding when the world's not growing. And that's the interesting factor. If the world's not growing, you need microcaps more often.
Okay, so this fund was launched in response to demand or because you think that investors need these stocks?
To be fair, it has to be a bit of both. I mean, we absolutely have promoted it. We believe it's absolutely the right time. Microcaps are probably very underrepresented in most people's portfolios where the mainstream benchmark stocks are the dominant part, quite a few mid-caps, not many small caps, very few microcaps. So we think this is an area which is underserved, but most particularly because world growth is slow, most particularly because companies are under pressure to maintain dividends or cut dividends in certain cases, we think that there's a greater interest in widening the opportunity set, including more names, including microcap stocks, and we think we can make absolute gain, not just because these companies can resist the world pressure, they can grow when the world's not growing, but also on top of that, because we think capital will be allocated away from bigness into smallness, in small size, and that will make a major difference in terms of the performance of the sector.
It was interesting because there's been a lot of interest around the microcap sector recently and around startups, unlisted companies, etc. So we had Neil Woodford's Patient Capital and Baillie Gifford have a similar type of fund, etc. Yeah. And of course there's the rise of crowdfunding. So lots of investors have become really interested in getting into smaller companies, getting into new companies, getting into local companies. And I look at that and I see it as symptomatic of two things. First, as you say, there being very little growth at the top, and also a sense of distance. Big companies are now so big, so global. Investing in them, you have no real sense of connection to them. So is it partly that retail investors are feeling very disconnected from the wider financial world, from the stuff at the top, and they want to come down to small levels and connect with things that they feel they really understand and they can share in the growth of?
I think that's been true for quite some time. I think with ISAs and the ability to inheritance tax planning and those kinds of things, I think there's always been a good participation of private investors at the bottom end of the market, probably even more than institutional areas. I think what's happening now is we find that the institutional interest, which generally has felt that these are too small to make a difference, they're now saying, well, actually, although we can't put a lot in there, just putting extra amounts in there not only enhance our return for our clients, but because they're less volatile and they zig and zag at different times, they actually make a reduction of overall volatility for those clients who actually have a mainstream portfolio of large companies, as well as holding a microcap interest. So the reason why this fund's been set up and the reason why we've raised new capital more recently is because actually institutional investors are joining private investors, holding companies at the bottom end of the market, because they believe that the prospects, like we do, are more attractive.
Okay, so they see it partly as a diversifier anyway.
It's a diversifier, but more importantly, the zig and the zag of some small micro isn't always in tune with the main market. And so having things which are zigging and zagging at different times means that the overall volatility of clients is smoother, and that's really important, because with this volatility out there, a lot of clients are really finding it very uncomfortable holding their assets and not sure whether they're going up or down every afternoon.
They shouldn't be looking every afternoon.
They shouldn't, but they can't help it. It's on the news every afternoon. It comes on. The market's up, the market's down. Would you believe it? It's gone down 3% today. Oh my goodness, it's up another 4% today.
But you wouldn't worry about that kind of thing, would you? Solid long-term investor. So you should be telling them to just, go away and mow the lawn.
Of course, but we're in the real world, and people's wealth, they're very interested in making a return, but also they're very, very interested in having a certainty about it long term, not losing them too much. And so it's very anxious. And the market then fell nearly 10% in about 6 weeks at the start of this year, which was really quite a shock. No one predicted it. It was all sort of very sudden, what was causing it, etc. So it's been an interesting period, because it's now recovered a large part of that, but the anxiety level is still very much out there, in my view.
Do you think that pensions freedom has made people feel more anxious than it did before? In that in the past, people didn't have to worry quite so much about where the market went and didn't go. If you had an annuity, or if you were involved in a defined benefit system, whether the market went up or down was always entirely by the by. But now that people have so much more personal responsibility for their pension pot, I hate the word pot, but there it is, their pension pot. Everyone is responsible for this. Levels of anxiety among the retail investor are much higher than they used to be, aren't they?
Well, absolutely. The tyranny of choice, of course, is that you can have too much of it, and then it's not just a case of making the choices. You've then got to decide, once you've made your sort of general selection, you've then got to make more specific selections, and you might make a decision which is very different from other people's and turns out less good or indeed badly for you. So there are real pros and cons. I mean, you can still buy, what's it called?
Give me a clue.
Yes, an annuity.
An annuity.
You can still buy an annuity, but the returns you get on it are so very low that it really doesn't look very attractive.
Yeah, well, that's interesting, of course, because it's getting rid of annuities may be bad policy piled upon bad policy, in that one of the reasons I strongly suspect that we ever had pensions freedom in the first place is because annuity rates were so low as a direct result of interest rates being too low, as a direct result of the financial crisis, in turn a direct result of interest rates being too low. Exactly. All these bad policy choices led us to a point where the soon-to-be retired and the retired were complaining vigorously and constantly about very low annuity rates, which brought us to what may well turn out to be another bad policy, which is pensions freedom. So it's an example of just piling them up until it all gets a bit out of control. That wasn't a question. That was a rant.
Yeah. Well, I can understand it. I mean, it is. I mean, joking apart, there's a lot of anxiety out there, and putting responsibility on individuals who sometimes feel they're not as close to the matter as they'd like to be, in terms of making really quite major decisions about very substantial amounts of capital.
Yeah. Well, talking about what people need and what people think they need, what people need and what they believe they need more than anything else at the moment is income, which they can't get. Now, mostly people look at smaller caps and they look at micro caps, they look at startups, and they think, well, I'm not going to get any income there, so they go to the large caps for income. So we've seen over the last 5-6 years sales of income funds being absolutely the highest. You go look at anyone's ranking of sales, and income funds are always absolutely at the top. And of course, now we're beginning to see that the very big companies in the UK that have been forced for years to pay out possibly too much of their income as yield, and beginning to think, well, they need to cut back on that. Obviously, you look at the dividend cover, it's not really high enough. It's time to cut back. But they're under quite a lot of pressure from the income fund managers to keep shoveling the income through. So you have two problems here. One is that too much income is coming out, and that will probably end up being cut. And second, that as a result of that income coming out, they're maybe not investing as well for the long term as they should. So the case for investing in large caps for income is beginning to fail. And I think you argue that there's a very good case in investing much further down the size scale and still being able to get income.
Absolutely right. I mean, to be fair, we shouldn't write off all big companies. Legal & General reported today.
Go on, it's much more fun if we just write them all
Legal
off
& General
completely.
grew its dividend by 17 or 18% this morning. I mean, it's been a great investor. It's grown its dividend at about 20% compound for the last 5 years. No embarrassment. We absolutely hold that in the diverse income. We're very happy with it. So absolutely, there is a place for big cap income, but there aren't so many of them. And so widening the opportunity set, investing in small companies, like, say, Amino, a company I saw last week, which is a company which is involved in sort of set-top boxes. It's quite a market leader. It's doing terrifically well. It made an acquisition.
Set-top boxes, telly stuff.
At the top of tellies, yes. Think of videos coming over the line, that kind of thing. But basically, it's actually made an acquisition. It had a little bit of unsettlement following the acquisition. Share price came down, but it's trading fantastically well. It's probably on about just over 12 times for the year just finishing in November this year, 10 times next year, with a yield of 5.25%, grown at 10% per year for the last 5 years. Net cash on the balance sheet. Well, we're not embarrassed to hold some of those too in the fund. The share price is probably too low because of its wobble, but most particularly, income and growing income will drag that share price up in time. And as long as we spot those companies which have invested sufficiently, which have got the payback on that investment coming through, the productivity improvements, that's what drives return. And we're finding that, yes, in some big companies, but most particularly across the whole market, particularly in the smaller end of the market.
Okay, give us a couple more. I mean, you said earlier that there were quite a lot of small caps about whose prices have been pushed down quite a lot at the beginning of the year and hadn't come back as you feel they should have.
Yes, I think the main driver is you've got to be companies which are going to invest capital for commercial payback. So this is productivity. It can be manufacturers. So take, for example, Coral Products, which is a tiny company, about 20 million market cap. It does plastic products, injection moldings. Some of those Ocado sort of big crates they carry around. Those kind of things don't come from China. They're too weighty. They've got too much air in them. They can just make them locally. So they make those kinds of things. Lots of other things too. Superb acquisition earlier in the year.
Where are they based? Are they part of our Northern Powerhouse?
They are part of the Northern Powerhouse. They've got a couple of factories either side of Birmingham and one near Manchester. But most particularly, they are involved in making acquisitions, which in their case, they made an acquisition from the receiver, which they paid about £160,000 for, which was 3 million turnover, making some profits. It was pension liabilities, which put it into receivership. So that was a brilliant acquisition. And they've followed it up with another acquisition more recently, which takes that acquisition, the first acquisition, and gives them a greater access to market. So there's a business which is probably on 10 times falling to 8 times, with a yield growing from 4.5 through to perhaps 6 going forward. In only 20 million market cap, tiny, accepted. But isn't it wonderful to meet companies which are investing and able to have the confidence to grow their business when the world's in an uncertain period at the moment?
Interesting. Let's just step back briefly. You mentioned that they'd made an acquisition, a company that had gone into administration because of pension liabilities. Now, this presumably is a huge and not going away problem for a lot of the smaller and mid-cap companies that you see. The lower interest rates go, the bigger their pension liabilities get, the more cash they have to shovel into their pension funds, the less cash they have available for investing in the future and paying out as dividends. How much of a problem is that, as you're seeing it?
It's become a significant problem. Many small companies do have liabilities on the pension savings schemes, and so that's been a problem. Bizarrely, of course, with interest rates as low as they are, one hopes they don't go much lower. We've seen negative interest rates in Japan. Let's hope we don't go anywhere near that in the UK. But what's actually pleasing, and I was talking with a company just yesterday about it, is they were actually looking forward to interest rates going up because their pension liabilities drift away.
Well, exactly. That's what I was going to ask you, in that if you have a lot of companies where you approve of their core business, and their core business is in very good shape, but they have a big pension deficit, surely the trigger to buy them would be interest rates rising.
Absolutely.
So it'd be wonderful to make a list of those.
Well, I mean, look, interesting enough, we tend to skew towards companies with strong balance sheets anyway. So many of our companies have net cash, or if they have net debt, it's very small amounts of net debt, lots of headroom. So most of our companies would be beneficiaries if interest rates went up. Not because they're going to make a lot from their interest, it'll just be slightly more, but most particularly because they can continue to invest, and perhaps more geared companies are more constrained. And it's that difference between being quoted, the access to capital, risk capital, when perhaps mainstream unquoted small caps are probably more constrained, which gives them the ability to get that productivity improvement, generate those cash paybacks, and drive dividend growth. I think dividend growth is really important. If you go back to the 70s and the 60s, one of the reasons why small micro outperformed wasn't just that they grew faster than the main market, but they grew their dividends above main market. That's exactly what's happening out there right now, and that's why we're so confident about the chances of small micro companies particularly outperforming, not just this year or next, but over the next 5 and 10 years.
Let's talk a bit more about the Northern Powerhouse. Investing in these kind of companies, you must be spending a reasonable amount of time visiting what we like to think of as the North, but is often actually the Midlands, right? Does the Northern Powerhouse exist?
Yes, it does. What we probably overlook is, I mean, we are the fifth largest nation in the world in terms of GDP, but we still have actually quite a lot of manufacturing businesses up there. We still have a lot of service businesses. It's not just the automotive industry. We've actually got quite a lot of range of areas in the aerospace and some of the more technical areas like Formula One cars and that kind of thing. There's a lot of areas where we're very world leaders, and the companies which have survived have had to be good. They couldn't have not been good. The valuation of sterling's been high at different times. We've had a lot of sort of brain drain to perhaps the south, and so there's actually only the really best companies that survived. And it's so thrilling to meet these companies, and it's not just good companies. It's recovery stocks which are on the turn, stocks which are then seeing recovery and able to invest. A company I just saw a couple of weeks ago was Avintrans, which is a company which is in a mainstream engineering business, heavily involved in the aerospace industry, doing things for Rolls-Royce. Just got a major contract in the last few days for Rolls-Royce, and there's a business which does have a pension liability, which is hopefully going to fall away, but most particularly because it's investing, is able to take on more orders, and is probably still only a P of 12, but is a mainstream world leader in its little area and can continue to improve. And if anything, I think it just hasn't had the attention it deserves, and hopefully people like us and other investors are going to start spending more time with these companies, allocating more capital so they can invest in a little faster and grow their businesses in a more important way going forward.
Interesting. And they can't borrow to do that?
They can borrow, but I'm massively suggesting they don't, because I don't know how bad it's going to get. We worry about whether China, is going to recover very strongly, or perhaps it won't. We know that perhaps the European area has not grown as much as we thought it would have done. Even in the US, with rising interest rates, maybe there's quite a lot of inventory in the US at the moment, that may not grow quite that fast. So world growth is going to be very limited. It's going to be very spiky out there. The last thing I want is a company to take on borrowings and then get caught out because it's got too much debt.
Yeah.
Much better that they take on risk capital. They've got it for certain, they never need to repay it back, and then if they can get that productivity, they pay a dividend and they grow that dividend, and as I say, that dividend growth drags the share price up, and they get a premium rating when they can raise more capital at a better rating in future.
Now, are the kind of companies that you invest in less at risk from Brexit than big companies, in that we hear an awful lot from the large companies in the UK about how awful Brexit would be and what a disaster it would be, etc., etc. But of course we know that one of the reasons it would be difficult for them is because they've spent an awful lot of time lobbying in Europe, and they've built up nice regulatory moats which have limited their competition, etc. One of the reasons why we have such lovely oligopolies at the top of many of our sectors. The smaller companies which don't do particularly large amounts of business with Europe and which are not involved in that regulatory lobbying anyway, may find post-Brexit that it either doesn't make much difference or it's a positive.
I'm not so sure. I mean, I think there are, we call them small companies, but often these companies are quite international. They've got operations in Europe and the US. Zoophone's reported this morning, it's got very exciting prospects, So there are plenty of companies which will have both sides of this argument. My view is that probably the arguments both for in and out are probably exaggerated in the economic sense. It'll make a difference, but probably not a big difference either way. Probably a bit more uncertainty if we come out, but either way won't be a big difference. But most particularly, we're going to continue to need to be nimble as a nation, because 3 years ago none of us were talking about oil price going down 2/3. So there'll be many other factors which turn up which could have even more profound influence, and we need to make sure that our capital is invested in those companies where the productivity improvement can come through. Nimbleness, agility, those are the things we're looking for, and we're looking for companies which can continue to take advantage of whatever change. So if we come out of Brexit, if it all happens that way, then we will be making sure that we can steer our capital into those companies which can take advantage of that. Maybe there'll be more tariffs, maybe we'll need more manufacturing in the UK. We can invest on that. If we stay in, then there's more certainty about being in for the long term. We can invest in companies which are going to sell more into Europe. So I don't think it's in itself it's the main issue. It'll continue to be a major issue, but I think we'll be surprised by other events which probably overtake it in the next 3 to 5 years.
Okay, interesting. So regardless of Brexit, if you had to invest in 3 companies for my children's education,
Yeah.
which ones would they be?
Well, I love companies which actually just have fantastic duration about them and growing the dividend. So an example of that might be a Mucklow, which is it's an industrial property business around Birmingham. It actually is probably the dominant player in that market. Now, over the last 20 years, we've seen a lot of people migrating manufacturing capacity to Far East and other places. And so effectively, their warehouses have hardly moved in price. Their industrial properties, you still get them for £5 or £6 a square foot, which compared with Bristol or Slough is ridiculously cheap. Now, what they found recently see is that people aren't moving to China in the same kind of way. In fact, some people are coming back into the UK, of course, Jaguar Land Rover.
Reshoring is real.
That's right, and it's got real property. You know, it's valued in their portfolio at about 7% yield. It's growing their rental levels, and a 7% investment portfolio growing its income at the top line is very exciting. And they're able to even put up new warehouses on some of the surplus land. So that's absolutely a company which has grown its dividend, I think, about 40 or 44 years in the last, since it's been quoted. 4 flat years, but generally growing.
And is that in the microcap fund?
It isn't actually, because it's probably a bit over 200 million market cap, so it's quite a decent sized business, but it just shows what the opportunity is there. I mean, also, any company which has got the ability to recover, we love recovery stocks. Although you can make money out of technology, not everyone turns out to be an Apple. Apple is probably one of the few exceptions, so much better to buy recovery stocks. So an example of that might be something which is in the microcap trust, which is a Fulcrum Utility. It's a company which installs sort of gas and electricity pipes into small housing estates, industrial estates, local authorities, that kind of area. They own the pipes afterwards, but most particularly it's a regulated-led market, it's a recovery-led market. This company's already seen its share price recover as it's improved its services, but it's still even now only on about 12 times PE. It's just declared its first dividend. It's got net cash of about 5.5 million on the balance sheet. It's probably about a 35 million market cap, and it's growing its dividend beautifully from zero. So it's the recovery stocks which are the best opportunities in our view.
Okay, Brendan, that was 2. You have to give me one more.
Third one, I probably would go for something like, probably something which I've just seen actually, Seeing Machines. It's a lovely business. Its share price is very.
What's it called? Seeing
Machines. It's got cameras on your dashboard. They've done deals with Caterpillar, where now if you're driving one of those massive grey trucks in the mining area, it's very important you don't nod off because you were playing gambling last night or something. So effectively, it keeps you on the road, which is great. Now widening it to mainstream trucks, some railways, into aeroplanes. It's an immature company in terms of it's not making profits. A bit unusual for us to hold that, but it's in a recovery mode. It's share price is very, very undervalued in our view. And so if you're looking for something which doesn't have the yield yet, but over 3 or 5 years should pay a dividend yield, then that's absolutely what would be in our portfolio. And that's one of the reasons it's in the microcap trust, because most of the holdings in the microcap trust are companies which aren't necessarily paying a lot of yield now, but in 3 and 5 years, as their investment comes through, the cash payback on that could be great.
How many companies do you see? You've mentioned pretty much every company you've mentioned. You said you've just seen them. You've seen them a few months ago, etc. How many are you seeing a year?
We're probably seeing, within Miton, we probably see between 100 and 140 companies a month. I probably see 40 a month, typically.
You see 40 a month?
40 a month,
Do they come to you? Do you go to them?
Typically, they come to me. I go and see them as well.
Spend a lot of time on the train.
Yeah, but I've already done, a meeting already this morning. I've got one when I go back, etc. I've probably got 4 meetings today with corporates, which is great. That's the real value added. Getting involved in businesses, thinking about with them the problems they've got to solve. Clearly, the wonderful thing about fund managers, just occasionally we can write a check, and that can make a difference to clients, to these companies. So it's effectively a very two-way dialogue. It's probably the best part of the job. Why wouldn't you do the best part of your job more?
So you see yourself really as quite an activist investor? Active,
No.
Obviously, but activist?
No, I don't think we do. I mean, clearly, we have views about the way the company should be run, but we're only one shareholder. They'll have lots of other shareholders who may have other views. They should need to think about it. They need to think about what's right for the business, and then they need to convince us as to why it's right for the business. Most of the time we agree. If for whatever reason we take a different view, then we can sell our shares and move into another investment. There's so many pebbles on our beach. We don't need to be worried about whether this particular one is perfect in every way. We just need to make sure the risk-reward ratio on each individual holding is particularly attractive, and that the risk across our client portfolio is actually relatively low, and yet hopefully delivering a very attractive return. So we're not activists, but we are very engaged, and we're very keen to do everything we can to help the company be successful.
Brilliant. Gervais, thank you very much.
Thank you very much.
Anticipating that there's going to be a run on cash, that people are going to want real cash. And by real cash, I mean dollars.
You mean actual notes?
Pieces of paper.
Actual notes.
Pieces of paper, because the whole economy works on credit.